Hey, welcome back to the show. Great to have you with me again. It's the 27th of October. If you haven't already, subscribe to the channel, please. Like the video, ring that bell for notifications, tell your friends and family. Appreciate the support. Want to check in on the economy today, checking in on inflation, checking in on the Fed meeting Tuesday, Wednesday of this week, and checking in on the debasement trade. So let's start with the Consumer Price Index, which was released on Friday. Nice to know we got some government workers working. The BLS is doing their job. We had the Consumer Price Index out for the month of September. Month over month came up 0.3% against 0.4% expected and 0.4% in August. So a touch better than expected in the prior month, but still elevated, with the year-over-year CPI going up to 3% against 3.1 expected against 2.9 in the prior month. Not a good direction. Inflation is not under control. We still have an inflation problem, and we still have potentials for it to get worse when it comes to tariffs. So far, I believe tariffs are mitigated by the confusion around the tariffs. Exporters from other nations skinning up their profit margins. Buyers of imports, retailers of imports here, skinning up their profit margins a bit and not passing the full cost along. I expect more of that to happen. We still have challenges on the food side, of course. We look at the core CPI, excluding food and energy, the volatile sectors of food and energy. We see month over month on 0.2%, again, better than expected, 0.3%, and better than the prior month, 0.3%, but still elevated year over year, 3% on the core number as well, as expected. So we have an inflation problem. It's ongoing. So look at the monthly and unadjusted year over year numbers. We can see the big movers, certainly the energy sector, gasoline up 4.1%, fuel oil up 0.6%. Other movers were apparel up 0.7%, medical care services and transportation services up 0.3%, food at home up 0.3%. Year over year, the biggest jumps were utility, pipe gas service up 11.7% year over year, fuel oil up 4.1% year over year, used cars and trucks up 5.1% year over year, shelter up 3.6%, transportation up 2.5%, medical care service up 3.9%. We still have an inflation problem, and it's very evident. You can still see it in the grocery stores in the world around us, certainly in the food away from home category, and certainly when you consider the food delivery apps. So we still have an inflation challenge here that the Fed is trying to mitigate, says inflation's under control, and now we got to focus on a weak labor market. Let's just be real clear. For 4 years, the right, the conservative right, harangued the Biden administration for what was an underlying weak labor market on the back of high month-over-month non-farm payroll gains that were all revised lower, as we all know. And when you look at the employment market, what we find is very few full-time jobs being created. The most Americans ever working multiple part-time jobs, the driving force for job creation in the whole economy. So the job sector has been weak for a while. Tying into this, of course, we have a Fed meeting this week. The FOMC, the Federal Reserve Open Market Committee, is meeting Tuesday and Wednesday of this week to make an interest rate decision on Wednesday afternoon at 2 p.m. And the market's expecting them to cut the federal funds rate another 25 basis points down to 3.75 to 4%. And I think they're making a big mistake. I've said this for many, many months now. Just leave interest rates alone, Fed, FOMC, Powell. Please leave interest rates alone. I've been a monetarist since I started studying economics in the 1980s and 90s. I believe in monetary policy, but since 2008, 2009, the Federal Reserve has sullied their reputation when it comes to monetary policy, making life difficult for monetarists. We have hooked the economy on exceptionally low interest rates, and they want them back again. They want zero interest rates again. Leave some bullets in the gun. Leave some arrows in the quiver. How that better? So the Fed's expected to cut rates on Wednesday by 25 basis points, and the market has them priced in another cut in December, taking us down to 3.5%. No. Stop punishing savers. Stop fueling the fans of inflation. Housing market does not need lower interest rates. The business world does not need lower interest rates. The economy overall does not need lower interest rates right now. Leave the federal funds rate unchanged. And what the Fed really needs to do is get away from this ample reserves model. They've been running for some years now after Ben Bernanke broke monetary policy with the unusual monetary policy of zero interest rates, quantitative easing, the twist, a huge increase in their balance sheet, have just screwed over savers and retirees, forced money into the riskier stock market. And it feels like that's their only mandate right now, is maintain the wealth effect, maintain rising stock prices. So I like to see the Fed move away from the ample reserves model, go back to the federal funds rate model, required reserves, get rid of interest on reserve balances. That's killing the Fed. It's killing banks. Instead of cutting interest rates, get rid of interest on reserve balances. How about that? Force banks to take more risks, to make more loans. As I've been calling for a long time, I want the Fed to remain on hold. I've been calling for this since the interest rates are up at 4.5 to 4.75%. I hope that this CPI data we had on Friday spooks them a little bit. We have a dearth of labor market data. Last we've seen is initial claims data still in the high 200 teens, 220s. Clearly not in the recession area. To the extent we know, the current unemployment rate is measured by the Employment Situation Report is hovering somewhere in the mid 4% range, well within full unemployment. So apart from getting rid of the ample reserves model and interest on reserve balances, what the Fed also needs to do is have its mandate change. We need Congress to change their mandate. Only one mandate, stable prices. Get rid of the dual mandate of full employment and stable prices. In fact, I would urge the Fed to ignore the employment mandate. I want the Fed to stop the wealth effect mandate, stop the plunge protection of the stock market, get rid of interest on reserve balances, go back to the federal funds model. And I want Congress to change their mandate to one thing only, and that's stable prices. So I want to talk about the debasement trade. In the face of soaring gold prices, new record highs, Bitcoin rallies, stocks, unrelentless climb to the high side. There are those in the financial analyst world, the market economist world, that have to explain why prices move, why asset prices move. It can't be as simple as there's more buyers and sellers in an up market or more sellers and buyers in a down market. They have to find something to attach to it. And very often that's doable. You can find reasons why markets move one way or the other in a given day based on fundamental information largely related to macroeconomic issues. And so gold has gone parabolic. Bitcoin, of course, is a pyramid scheme driven only by getting more people to buy it. And analysts have begun to talk about something called a debasement trade, that the rally in gold and cryptocurrency is a message to the fiat currency world that they're worthless, that the only way America can save itself, debase its currency, which essentially means let inflation take care of our debt problems. Let the dollar collapse. Dollar has no value. I'm here to tell you that argument is a load of BS. There's no debasement trade. None of that. Instead, what's driving gold, what's driving Bitcoin, what's driving equities is pure speculation, raw, unbridled speculation. And you see it most obviously in the gold chart. Gold has gone parabolic. Key signals for a debasement trade would be a weakening US dollar in the foreign exchange markets and rising interest rates on the long end of the yield curve. We don't see that. Dollar is still relatively strong against every major currency in the world, especially currencies like the yen, certainly still against the euro. Since mid-2022, we've had a range of $0.9799 to the euro to $1.1642 to the euro. Dollar approaching 1.5 would be concerns about the dollar. We're still well within ranges of relative strength for the dollar against the euro, against the yen, against the US dollar index. The dollar has sold off over the past several months in the face of lowering interest rates. Interest rates are a key driver for foreign exchange rates. And we even see here in the dollar index that there's no panic going on in the US dollar. This idea of the debasement trade is covering up one very ugly thing about markets, and that's pure speculation. Remember now, gold is an industrial metal. We think about inflation, which the debasement trade people are trying to fight against. We're thinking about serious inflation with this price of gold rising. The price of Bitcoin, that's serious inflation. the pyramid scheme that is Bitcoin. Buy that at your own peril. The only way it goes higher if you get more people to buy it. That's it, period. That's also pushed along by the unbelievably silly efforts by the Trump administration to create a crypto reserve fund. Talk about the libertarians got to control of Trump. Holy cow. Trump's not controlled by conservatives as much as he's controlled by libertarians. Anyway, inflation remains a problem. The Fed is going to cut rates on Wednesday. They should not. They should remain on hold. If they do cut on Wednesday, they better not cut in December. And the debasement trade is a bunch of BS. Gold and crypto equities driven by pure speculation. We have the everything bubble as a result of horrible monetary policy for the past 15, 20 years. All right, that's all I have for you right now. Always try to buy American.